Welcome to Subramani. Why do we invest? The reason for investing is putting some amount of money today so that after some time you can get a amount bigger than that, right? So whether it is short term investing, whether it is long term investing, you call it value investing, we invest to get a return which is superior to what any other form can give, adjusted for inflation and taxes, right? That is the reason why we invest. So why do we invest in equities? We invest in equities to get better returns. Same thing, I mean, any investment is to get better returns. And there are two ways how you get better returns when you invest in equities. One is appreciation, the share price going up, largely it is that, and second it is the dividends that you get, right? So especially adapting a portfolio for a retirement person is like saying let's use the word pensionize. I need to pensionize my assets, right? So that is what you need to do when you're retiring. So what do you do when you're young and you're trying to build a portfolio? What should you look for? Everybody tells you, including Warren Buffett, that you should look for dividends, right? I mean, I'm sure many of you know, but many of you do not know that Berkshire Hathaway pays no dividend, just doesn't pay dividend. If you want money, you have to go and sell the share, and that is a brilliant way of managing the money, saying, look, you have 10,000 shares, go and sell whenever you want. You sell 1 share, 2 share, 10 shares, 100 shares, whatever you want, you sell. And whenever you don't want to sell, the appreciation will always be there. This is like opting for the growth option in a mutual fund, right? But when I'm talking of dividend, I don't want to confuse you with mutual funds. Here I'm talking of equity portfolio and dividend, right? What are the advantages of two ways how a company can compensate you. One is by paying you a nice dividend, and second is by doing buybacks. So when they do buybacks, and it's assured that every month or every year or every quarter, if they are doing a buyback, you can be sure that at a particular price there will be somebody buying. Like for example, if TCS did a last buyback at 4,000 rupees per share, you can be sure that next year, if they do well, they may increase the price to 4,100 or 4,200. This has two advantages. One, it gives you the base, saying, okay, if I buy at this particular price, if I buy it at 3,100, very unlikely that I will lose money, because I know the company will come out with a buyback in July or December or whenever, and they will buy it back at 4,100, which forms a very good solid base for the retail shareholder to say, okay, if I have these shares, I can give it for a buyback. So the downside gets protected because of the buyback. But largely companies pay you good dividends, and that is like being rewarded for sitting tight doing nothing. So sitting tight doing nothing, you get rewarded in terms of dividend. Unfortunately or fortunately, it is taxable now, but I think for 99% of the people, you will still be paying a tax rate less than what the dividend distribution tax was. Forget people who are promoters, etc. They would be paying a whooping high rate of tax, maybe the 40%, 44%, and 40%, 30% plus 30% surcharge kind of a thing. But for most of the others, you would perhaps be paying at 28%, so it's not too bad. But that is the reward for sitting tight. Now, when you're young and you're building a portfolio, you should not have to concentrate only on dividend. You should concentrate on dividend, buyback, and growth. What does a company do with the money that it gets after tax, right? There is EBITDA, then there is interest, depreciation, tax. After removing all that, there is PAT, right? So what does a company do with PAT? One, it can plow back into the business. So when you understand plowing back, it is the power of compounding of the undistributed profits. Let me say this again, the power of compounding of the undistributed profit. So let's say the company gets 100 rupees as profit after tax. 30 rupees it pays off as dividend, it is left with 70 rupees, and that 70 rupees gets put into the business, right? So your 30 rupees which you get it, and you I'm ignoring tax for a minute, you take that 30 rupees and reinvest. Maybe you reinvest in the same company, or you reinvest somewhere else, right? But you reinvest, or you spend it if you need. If you're a retired person and you need that income, you spend it. But that 70 rupees gets plowed back into the business, and that also compounds. You should not think only your 30 rupees is compounding, that 70 rupees is also compounding. That is a huge advantage. So a good company which is compounding that, which is using that 70% more efficiently, definitely is compounding at a better rate than perhaps what you can do, right? Let us assume for a minute that Bharti Airtel is compounding that 70 rupees, Reliance is compounding that, Zomato is compounding that, and Nykaa or a Paytm is also compounding that. Remember that they may not have profits, but whatever profits they have, very unlikely that they will pay out as dividend. They don't have Indigo, for example. They need all the money to buy new aircraft, right, to expand, open more offices, reach more places, right? So they need, so these are growing companies. So when you're building a portfolio, you need both. You need an NTPC, Coal India, GAIL, IOC, BPCL, which will give you very good dividends. And you need companies which are growing today, let's say for example Zomato and Indigo, which will grow after 10 years. So for next 10 years, you may see gut-wrenching volatility, but you are very unlikely to hold a Zomato or an Indigo for dividend. Right now, no, but after some time, you will find that, oh, Indigo is part of infrastructure, it gives a nice stable 8% return or a 7% return. So it will become a dividend story at some stage of its life, right? So a Bharti earlier used to just not pay any dividends, and it has to grow, right? Vodafone Idea today will not be able to pay dividends. It will have to grow, it will have to reinvest. So you have to look at a company, when you're looking at your own portfolio, you look for 2-3 things. You look for current dividend. But when you're in your 20s or 30s, current dividend should not matter at all. In fact, it should not, you should not seek it at all, simply because you don't need that cash flow. However, I still like companies which pay good dividend. If I can get a company with giving me 4-5% dividend yield and a 20 PE, I think it's a great company to invest, and I would stay invested pretty long. I mean, I've invested pretty long in say NTPC and all. I have bought, I have sold, but the dividends never hurt me, and it is available at a low PE, right? Just a caveat, every share that I have mentioned, I have looked at it. I have a position which is plus, or I have said I don't understand it, so I have not invested. So all these shares, you can assume that I know these companies. Some I would invest, some I wouldn't invest, and even if I have invested today, by the time you watch the video, I may have sold. So don't believe that these are tips. These are not tips. So I also realize that in your own mind, building a position, sizing also takes a lot of time. Like for example, a mutual fund can't build a 12,000 crore, 13,000 crore kind of a Bharti Airtel in their portfolio, or even State Bank of India in their portfolio. It takes time, right? It takes a month, it takes 2 months, and to sell it might take 6 months, right? So building positions and all, you do it very conservatively. Sorry, I've digressed, but largely you look for a company which pays a dividend and it plows back. Now take a company like Berkshire Hathaway. It does not pay any dividend ever. It just keeps reinvesting. Whenever it has money, it reinvests, or it sits on cash. Sometimes when it's sitting on cash and it has nothing to invest in, or does not know how to deploy, it does a buyback also. So you should look for 2-3 things. You should look for companies which are growing at a good pace. They will not be able to pay you dividend in 2022. They will be able to pay you in 2032. So if you are now 50 years of age, that's a good thing, because they'll start paying dividends at 60, and anyway you don't need dividends till 60. I'm assuming for a minute that 60 is your retirement age. So you should look for some companies which are, and if you're 60, you should look for some companies which are paying you dividend now because you want to live off it, and some which will pay after 10-15 years because you will be 75-80 at that time, and that time those will become good dividend yield shares. So companies will move from the very heavy investing stage to the nice dividend payout stage. Second advantage is when you are looking at dividend, you do not need to look at the day-to-day price fluctuation. That is another huge advantage. And you don't have to bother what the market PE is, what is happening, and this gut-wrenching volatility will not bother you. For example, I mean, international example would be Johnson and Johnson. Obviously, Johnson & Johnson share has also done all this ups and downs, not very high, but it has done its ups and downs, but it has consistently paid dividend for the last 70, 80 years, whatever. So what happens is people who have invested just are looking for good dividend. So when you're building a portfolio, you build some which will be investing all the money and growing, some which will be paying dividend and growing, and some which does not know what to do with the money, so will be paying a higher payout. So the MNC group in India, like the HUL and Colgate, Nestle, we try to paint them all with the same brush. Not true. Colgate is not growing as aggressively as Nestle. Colgate and Nestle may not be growing as aggressively as HUL. So also remember that these companies, if they are not growing, they have cash. So what will they do? They will give it back to you. So therefore you have a higher dividend payout or a buyback. So buyback is very unlikely in many of these MNCs. So I'm not saying that they won't. So buyback is unlikely. So the dividend payout will be high. So those are good shares to hold for your dividend, but 10 years later or 5 years later, because at current prices it will none of these shares are a dividend yield stock, right? But they will become dividend yield stock at your cost after 10 years. It's like doing a growth investing. You put money today, because 10 years later the dividend will start looking attractive because the share price would have moved up, but you don't have to worry about the share price because you are dependent on the dividend. Now this is a nice way to build a portfolio for a retiree. So if you're young, you're 32, you still build your portfolio. Don't look at dividend payout. See the compounding of the money that is there. A company with a good return on capital, ROCE and RONW, should not give me dividends. I don't want dividends from companies which have a good ROCE or good RONW. I want them to reinvest that. The fact that they are paying a high dividend while getting a good ROCE and RONW makes me upset that, oh, they don't seem to have any growth plan, right? So some should be looking at growth 10 years later. Some portfolio should be paying current dividends. So depending on your age, if you're 22, you need companies which are compounding more. If you are 62, you need companies which are paying out dividend, because you are going to use it for your day-to-day expenses. I think one of the best ways to build a portfolio for retirement is to look at dividend growth, but don't ignore the compounding of the retained earnings, right? That is also important. So don't say, oh, I should only look at this. No, if you're 50, you should look at a combination of current dividend and future dividend, right? In fact, you can ignore current dividend because you are anyway salaried, right? So if you're salaried, don't bother too much about current dividend. But when your salary stops, the dividend should be greater than your expenses. I think one important criteria which I used for my retirement in 1999 was saying, is my dividend enough to take care of my household expenses? The day I could say yes to that, I just quit, right? So the other advantage of having a dividend portfolio is you're not touching your capital for a very long period of time. So at say 70 years of age or at 75 years of age, you need to withdraw from your capital. It should not unnerve you, because your capital would have run dramatically well if you have not touched it from the age of 60 to your age of 75, right? So 15 years, let us assume it has doubled twice. You've done just fabulously well, right? So, and your dividends will also grow, because dividends normally grow at a rate faster than inflation. This is how you build a portfolio, whether you're young or whether you are at retirement. Thank you.